Hello, so this is for the subject capital markets, and the specific topic for this video is term structure of interest rates. So I have here an article from investopedia.com. So for the definition, term structure of interest rates, commonly known as the yield curve, depicts the interest rates of similar quality bonds at different maturities. So essentially, it's measurement of return. Key takeaways: the term structure of interest rates, commonly known as the yield curve, depicts the interest rates of similar quality bonds at different maturities. The term structure of interest rates reflects expectations of market participants about future changes in interest rates and their assessment of monetary policy conditions. Okay, so it's related to monetary policy. Depending on the situation of the economy, so the monetary board through the central bank could increase or decrease the interest rates prevailing in the market. One commonly used yield curve compares the 3-month, 2-year, 5-year, 10-year, and 30-year U.S. Treasury debt. Okay, term structure, I think this would pertain to the length of holding time or the period that a certain investment or a certain security is in the hands of an investor. Okay, term or period. Essentially, term structure of interest rates is the relationship between interest rates or bond yields and different terms or maturities. For example, in terms, you have 30 days, 60 days, 90 days, 180, 1 year, 2 years, 3 years, 5 years, 10 years, or more, right? When graphed, the term structure of interest rates is known as a yield curve. So essentially, you're just comparing how much is the return or the yield on the different types of investments with different maturities or terms. All right. It plays a crucial role in identifying the current state of an economy. The term structure of interest rates reflects the expectation of market participants about future changes in interest rates and their assessment of monetary policy conditions. In general terms, yields increase in line with maturities, or the longer is the investment, so the higher is the return or the yield. So yield is just another term for the return or the profit or the earnings. Okay, giving rise to an upward sloping or normal yield curve. The yield curve is primarily used to illustrate the term structure of interest rates for standard U.S. government-issued securities. This is important as it is a gauge or measure of the debt market's feeling about risk. One commonly used yield curve compares the 3-month, 2-year, 5-year, and 10-year and 30-year U.S. Treasury debt. Yield curve rates are usually available at the Treasury's interest rate website by 6 p.m. EST each trading day. Right. The term of the structure of interest rates has three primary shapes: upward sloping. Long-term yields are higher than short-term yields. This is considered to be the normal slope of the yield curve and signals that the economy is in an expansionary mode. Okay. Downward sloping. Short-term yields are higher than long-term yields, dubbed as an inverted yield curve, and signifies that the economy is in or about to enter a recessive period. So that's why they are trying to compare the different rates applicable to investments with different maturity, especially government bonds. Okay, that's how they, that's how they assess in what stage the monetary policy is in, right, or the economy is in, by checking how the monetary policy is being implemented. Flat, very little variation between short and long-term yields. This signals that the market is unsure about the future direction of the economy. So, there's not much difference between long-term and short-term maturities of investments. They're essentially, having the same yield. Okay, moving on. U.S. Treasury yield curve. The U.S. Treasury yield curve is considered to be the benchmark for the credit market because it reports the yields of risk-free fixed income investments across a range of maturities. Okay? In the credit market, banks and lenders use this benchmark as a gauge for determining lending and savings rates. Yields along the U.S. Treasury yield curve are primarily influenced by the Federal Reserve's federal funds rate. Other yield curves can also be developed based upon the comparison of credit investments with similar risk characteristics. All right. Essentially, because the government bonds are essentially risk-free or has the least risk among all types of investments, so they are essentially the basis, or that's where they compare most of the investments. Most often, the Treasury yield curve is upward sloping. One basic explanation for this phenomenon is that investors demand higher interest rates for longer-term investments as compensation for investing their money in longer duration investments. Occasionally, long-term yields may fall below short-term yields, creating an inverted yield curve that is generally regarded as a harbinger of recession. Okay? And then lastly, outlook for the overall credit market. The term structure of interest rates and the direction of the yield curve can be used to judge the overall credit market environment, whether it's expansionary or recessionary. A flattening of the yield curve means longer-term rates are falling in comparison to short-term rates, because there should be a distance between the yields between short-term and long-term rates. So if it's almost the same, then the long-term are lagging behind or falling in comparison to short-term rates, which could have implications of recession. When short-term rates begin to exceed long-term rates, the yield curve is inverted and a recession is likely occurring or approaching. When longer-term rates fall below shorter-term rates, the outlook for credit over the long term is weak because, recessionary. This is often consistent with a weak or recessionary economy, while other factors, including foreign demand for U.S. treasuries, can also result in an inverted yield curve historically. An inverted yield curve has been an indicator of an impending recession in the U.S. Okay? Although currently, because of the pandemic, a lot of economies are in recession. And only upon, opening of the market would it grow again and turn positively. Okay? So again, a normal situation is that long-term investments should have higher yields compared to short-term investments. And if it's inverted, then the economy is likely in a recession. All right? So that's it for this one. This is about the term structure of interest rates. Thanks and bye.